Hey everybody, my name is Paul Vojchehoske and welcome to the Real Estate Classroom YouTube channel. Hey, before we get started on today's video over common loan clauses that you need to know for your real estate exam, hey, do me a favor, give this video a thumbs up, hit that red subscribe button, click on the notification bell, and if you have any questions or comments, put them down below in the comments section of this channel. And don't forget to share this with somebody. Okay, let's get to today's video. So in today's video, we're going to discuss 7 common contingencies or 7 common loan clauses that are really paramount in just about any loan document, including a mortgage, a deed of trust, or even a land contract. And those 7 clauses are due on sale clauses, sometimes known as an alienation clause. We have the acceleration clause, the defeasance clause, the release clause, the prepayment penalty clause, a subordination clause, and then finally what's called an assignment of rents clause. All 7 of these clauses are very important for you to know for your real estate licensing exam, and so we're going to touch on each one of these. Now, the first one I want to talk about is what's called a due on sale clause, and here's the thing to remember. There's another term or another way that it can be used, and that is called an alienation clause. So you have to know that these two things are the same thing and they're used interchangeably. I've seen them go both ways in loan documents. All right, but the thing to remember is alienation means transfer. So when this due on sale clause or alienation clause is included in a mortgage, promissory note, or a deed of trust or a land contract, then it requires that the loan balance be paid in full when, now there's a trigger here. So the loan balance will have to be paid in full if title to the property is passed. And this is interesting because most of the time people will just say, well, that means that the loan is paid off, but that doesn't really necessarily always mean that. So for example, it is not very common, but a lot of investors like to use this somewhat shady technique of what we call taking a property with subject to, meaning subject to the due on sale clause not being invoked by the lender. And so there is a loan against the property and the seller is in distress or whatever the case may be, and they transfer title over to somebody else, but they don't pay the loan off. So transfer of title has occurred, and in that case, what will happen is the bank has the right, under the due on sale clause, to then go to that borrower and say, well, you owe us this amount of money and it's due now. All right. So it's the key here is it protects the lender from the seller selling the property and transferring title and not paying off the loan. The other thing is typically when loans include any kind of due on sale clause, they are not assumable loans. The next clause we're going to talk about is called an acceleration clause, and it allows the lender to declare the entire balance due immediately upon default of the borrower, meaning the borrower stops making their payments, but it also does include other breaches as well. So for example, let's say that the borrower has stopped making property tax payments, or they stop paying their homeowner's insurance, or they stop maintaining the property as far as material condition goes. All of those are triggers in which the lender can then accelerate the amount that's due and basically declare that the entire balance is due now. Another thing that it allows the lender to do is to accelerate the balance due if the lender finds out that there has been a higher lien that's been placed against the property. So for example, a tax lien, for example, is considered to be a higher priority lien than the mortgage. And that means it becomes a senior lien against the lender, and therefore the lender could then use the acceleration clause to declare the entire balance due. Now, due on sale, remember the difference. Due on sale clause permits the lender to declare the entire amount due if the borrower transfers title. The Acceleration Clause allows the lender to declare the amount immediately due if they stop making payments or some of the other things that we discussed. Number 3 is a Defeasance Clause. It's kind of funny, Defeasance Clause, and you have to understand that the root word here is defiance, which means defeat. And this is when a mortgage is declared null and void or no longer enforceable or defeated, if you will, when the promissory note or the loan against the property has been paid in full. So essentially, when the borrower pays the property off, this is a legal mechanism that says that the lender has no more interest in the property and therefore their mortgage is now defeated. It's more of a legality or a technical part of the loan, but it is nonetheless very relevant and something that you have to know. So that is a Defeasance Clause. Number 4, a Release Clause, or sometimes known as a Partial Release Clause. And if you watched a previous video where we talked about the non-VA FHA type mortgages, we discussed a type of mortgage called a blanket mortgage. And in a blanket mortgage, it allows, for example, a subdivider or a developer that's creating or developing a subdivision to go to the bank and say, listen, I want to get $1 million loan. And as each parcel within that subdivision is developed and sold off, then it allows for a partial release. So that individual lien against that individual parcel of land is released by the lender. So it's a mechanism that allows individual lots or individual parcels to be released in a blanket mortgage. And these are very common in blanket mortgages, and quite honestly, I'm really not sure that there's any other type of mortgage where I have seen something like this other than a blanket mortgage. The 5th one is what we call a Prepayment Penalty Clause. Now, this permits the mortgagee, there's one of those key real estate terms, I know you've heard this before, but remember, the mortgagee is the lender and the mortgagor is the borrower. Have to know those. You have to know those for your real estate licensing exam. So the prepayment penalty allows or permits the mortgagee to charge a penalty to the mortgagor if the loan is paid off early. Now, the prepayment penalty clause will also describe or outline what that prepayment penalty is. And also remember that most federally backed loans won't have these prepayment penalties. So VA loans or FHA loans, they will not have these included. But essentially what will happen is the most common that I have seen is, so a prepayment penalty is typically from 2 to 5 years. Most common, it's 2 to 3 years. So it simply means that the borrower is going to pay X amount of money, $4,000, $5,000, $6,000, or a certain percentage of the amount of the loan in a penalty if they pay it off within 36 months or 48 months, those type of things. And it kind of protects the lender from the borrower in an environment where interest rates are falling rapidly. There have been times in my real estate career when interest rates or mortgage rates fell so quickly that literally people refinanced in a 2 or 3, 4 times in a 1-year period. And putting the prepayment penalty in there is a way to buffer against that, buffer the lender against that activity. Number 6 is a subordination clause, and I also spoke about this in a previous video as well. It requires any existing or future mortgage lien to be second in priority, or what we call subordinate, or be in a lower priority to this loan. So if you went out and got a first mortgage, and then you went out and got a second mortgage to maybe put in, to do improvements to the property, that second mortgage is in second priority. But let's say you refinance this first one. Well, if you refinance the first one, what happens is that will move that second mortgage up to first priority. And most lenders don't like that. So if you're going to refinance your first mortgage, then whoever you're refinancing with is going to require the second mortgage to subordinate. It's called a subordination agreement to guarantee that that new loan is going to be in first priority. That is one aspect of a subordination clause. It is also used, subordination clauses are also used in commercial leases, particularly in leases or commercial spaces where there are really long-term leases. And so think about this. So let's say a commercial property is paid off, and the owner, the landlord, enters into a 10-year lease agreement with a tenant. It's called a leasehold interest that tenant has. Well, let's say that 2 years into this lease agreement, the owner decides to take a mortgage out against the property. Well, because the tenant, the leasehold interest is in first place, if the lender ever had to foreclose on the property, the lender would then have to abide by the terms of the lease agreement. So it's very common in a commercial lease agreement or a commercial lease that says that in the event that the owner has a mortgage and that mortgage is foreclosed upon, then it allows the lender to terminate that lease even if the lease hasn't expired yet. So it's a way to protect the lender. These subordination clauses are very common in commercial leases. And the last one I want to talk about is called an assignment of rent. And again, this protects the mortgagee, which the mortgagee is the lender and the mortgagor is the borrower. It allows the mortgagee to collect rent directly from the tenant in the event that the mortgagor or the borrower defaults on monthly payments. This was very common in 2009, 10, 11, and 12 when many investors got foreclosed on, and many investors just simply gave up and stopped making house payments. So you saw a lot of lenders notifying or going directly to the tenant saying, from here forward, you're going to pay your monthly rents to us. That was very common during that time period. And it's just a way to protect the lender, because not having that, an owner could stop making payments but continue to collect rent. And in some states, with their foreclosure laws, it may take up to 2 or 3 years to actually foreclose on the property, depending on the state that the property is located in. So it's just a way for the lender to protect themselves against the borrower's default. Well, there you have it. Those are the common loan clauses that you're going to see in loan documents. But hey, real quick, if you are continuing your studies, don't forget to check this video out. It kind of dovetails into what we've been talking about in this video. And if you have not subscribed to our channel yet, I would appreciate you doing that. Click the little circle to my left. And that's all I got for today's video. I'll see you next time.